If you observe carefully the behavior of central banks over the past 18 months, you'll notice something extraordinary. They're dumping U.S. treasuries and buying gold at a pace not seen since the 1970s. But everyone's debating whether Bitcoin hits $100,000. They're missing what Bitcoin is actually signaling, and it has nothing to do with crypto. This is about the breakdown of a 50-year monetary system. By the time this becomes obvious, the wealth protection moves available today will be gone. Here's what's really happening. The signal isn't coming from Bitcoin itself. It's coming from the response to Bitcoin. When institutions that spent a decade calling Bitcoin worthless now file for Bitcoin ETFs, when countries with unstable currencies adopt it as legal tender, when pension funds start holding positions, these aren't random events. They're symptoms of a breakdown in monetary trust. And if you understand how these systems work, that breakdown leads to very predictable consequences for your retirement savings. This isn't a prediction. It's a logical consequence of observable mechanics. I've spent over 40 years studying debt cycles, how reserve currencies rise and fall, how monetary systems break down. What I can tell you with certainty, Bitcoin's rise isn't causing the monetary problem. Bitcoin is the canary in the coal mine. The mine is the dollar-based system. The toxic air is unsustainable debt and currency debasement. And the canary is singing loudly that the people who understand incentives have lost faith in the system's ability to preserve value. When you understand incentives, you understand behavior. Central banks have an incentive to inflate away debt. Governments have an incentive to spend more than they collect. These aren't moral judgments, they're mechanical realities. Let me give you 3 specific data points. U.S. federal debt is $34 trillion, representing 124% of GDP. The only other time we exceeded 100% was after World War II. But here's the difference. In 1946, we were the world's creditor. Today, we're the world's largest debtor, with an $800 billion annual trade deficit. Second, the Federal Reserve's balance sheet went from $4 trillion in 2020 to $7 trillion today. That's 75% monetary expansion in 4 years. Third, since 2022, central banks have purchased over 1,000 tons of gold while reducing treasury holdings by $300 billion. These aren't Bitcoin enthusiasts. These are the most conservative institutions in the global financial system, quietly repositioning away from the very assets they've held for 70 years. If you're still watching, drop a comment. What percentage of your portfolio is in inflation hedges? I read every response. To understand what Bitcoin is really signaling, you need to understand 3 fundamental pressures creating this crisis. First, structural debt that cannot be repaid. With $34 trillion in federal debt, annual interest payments now exceed $1 trillion, more than defense spending. To service this without raising taxes dramatically or cutting spending, the only mechanism left is inflation and financial repression. Keep interest rates below inflation, so the real value of debt shrinks. But that same mechanism destroys the savings of everyone holding dollar-denominated bonds. Second pressure, weaponization of the dollar. When the U.S. froze Russian central bank reserves in 2022, every other country got the message. Dollar assets aren't truly yours if geopolitics change. This accelerated the search for reserves outside the dollar system. Countries that held 70% in dollars are now diversifying into gold, other currencies, and exploring Bitcoin. Third pressure, the mathematics of unfunded liabilities. Social Security, Medicare, and Medicaid have unfunded obligations exceeding $100 trillion over 75 years. 3 ways to address this: cut benefits, raise taxes massively, or inflate the currency. The political impossibility of the first 2 makes the third almost inevitable. Bitcoin signals that people who understand these numbers are seeking alternatives that can't be inflated away. But here's where it gets interesting. History is an excellent teacher. In 1971, when Nixon closed the gold window, it wasn't because the system was strong. Foreign governments were demanding gold for dollars because they no longer trusted U.S. restraint. The Vietnam War and Great Society programs were being funded through inflation. Gold was signaling exactly what Bitcoin signals now: loss of faith in the issuer's discipline. What followed? A decade where inflation hit 13%, devastating for bonds and cash, extraordinary for hard assets. Between 1971 and 1980, gold went from $35 to over $800, a 2,200% gain. The signal was there in 1971. Most people ignored it until protection became expensive. The 2008 crisis had similar advance warnings. For 2 years before collapse, certain indicators flashed red. Credit default swaps on mortgages were spiking. Housing inventory was building. Those who read these signals repositioned into cash, treasuries, gold. Between October 2007 and March 2009, the S&P fell 57%. Gold rose 25%. The signal was there for those who knew how to read it. The pattern is always the same. Government faces pressure to spend more than it collects. It creates money to bridge the gap. Sophisticated observers notice first and reposition. The broad public notices later, after significant wealth has already transferred. Bitcoin is the current version of this early signal. Quick pause. If this analysis is making sense, hit subscribe. The next video breaks down specific assets to buy and timing strategies. Let me tell you a story that shows what happens when you read signals correctly versus ignoring them. In 2010, two brothers, both mid-50s, both with $800,000 in retirement savings, read about Bitcoin at $5. Robert saw volatility and speculation. He kept his conventional allocation, 60% stocks, 30% bonds, 10% cash, exactly what advisors recommended. Michael saw Bitcoin differently, not as an investment, but as a signal that something was breaking in the monetary system. He didn't put everything in Bitcoin. That's reckless. He took 5% of his portfolio, $40,000, and bought Bitcoin at $8. Another 5% into gold, kept 90% traditional. His thinking: if the signal is wrong and the system stays stable, I lose 5%, but the other 95% performs normally. If the signal is right and debasement accelerates, that 10% dramatically outperforms and protects purchasing power. 10 years later, 2020, Robert's $800,000 grew to $1.4 million, 75% return, about 5.7% annually. Respectable. Michael's traditional 90% performed similarly. But his $40,000 in Bitcoin at 5,000 coins? At Bitcoin's 2020 price of $19,000, $95 million. His gold position, $57,000. Total portfolio, $96.3 million. The difference between reading the signal and ignoring it, $94.9 million. Now you might say that's extreme. Bitcoin won't repeat that performance. You're probably right about the magnitude, but you're missing the lesson. The lesson isn't that everyone should have bought Bitcoin in 2010. It's that when major systemic signals appear, signals of monetary breakdown, unsustainable debt, positioning even a small portion as insurance can have asymmetric outcomes. Michael wasn't smarter. He understood that signals have meaning, and hedging against them is prudent risk management. Now let's translate this to what affects you directly. If you're 55 with $500,000 in a conventional retirement portfolio, IRA or 401k with typical allocation, you need to understand what this signal means for your specific situation. Your $500,000 is probably $300,000 in stock index funds, $150,000 in bonds, $50,000 in cash. The assumption: the monetary system stays stable, inflation stays moderate, bonds provide ballast, purchasing power is preserved. But what if the signal is correct? If inflation settles not at 2% but at sustained 5 to 6% for the next decade, plausible given debt dynamics, the mathematics are brutal. Your stocks might keep pace with inflation. Your $150,000 in bonds? If they're yielding 4 to 5% and inflation runs 6%, you lose purchasing power every year. Historical patterns: sustained inflation crushes long-term bonds by 40 to 50% in real value. Your $150,000 becomes $75,000 to $90,000 in purchasing power. Your $50,000 cash loses value at inflation's rate. At 6%, cash loses half its purchasing power in 12 years. Add it up. Your $500,000 becomes $400,000 to $425,000 in real terms over a decade. You've lost 15 to 20% of retirement security, not from bad decisions, but from not recognizing the signal. Are you seeing this pattern in your own 401k? Drop a comment below. That translates to concrete impacts. Groceries that cost $5,000 annually now cost $9,000. Healthcare jumps from $12,000 to $22,000. The trip to see grandchildren goes from $3,000 to $5,500. Your pension buys 40% less. This isn't fear-mongering. It's mathematics applied to scenarios that historically follow this kind of debt accumulation. Here are 5 practical guidelines for protecting yourself. First, rethink the 60-40 portfolio. That advice was designed when bonds yielded 7 to 8% and inflation averaged 3%. When inflation exceeds bond yields, the fundamental assumption breaks. Consider this instead: 40% equities, but selective. Companies with pricing power, real assets, international revenue, low debt. 25% in real assets that can't be debased. Gold, real estate, commodities, and yes, perhaps 3 to 5% in Bitcoin for those accepting volatility as the price of protection. 15% in TIPS, Treasury inflation-protected securities. They preserve purchasing power. 10% in short-duration bonds, 2 to 3 years maximum. 10% cash for liquidity and opportunities. This gives you 40% in assets protected against inflation, 40% in equities positioned for that environment, 20% in stability. Implement gradually over 6 to 12 months. Don't panic restructure overnight. Second guideline: what to avoid. Long-duration bonds get destroyed in debasement. Companies with heavy debt and low pricing power struggle when costs rise faster than they can increase prices. Don't keep excessive cash earning nothing. Move to money market funds or treasury bills minimum. Third, prepare psychologically for volatility. Gold can fall 20% before rising 40%. Bitcoin can fall 50% before doubling. This volatility is the price of debasement protection. Never put so much in volatile assets that you're forced to sell during drawdowns. The 5 to 10% allocation I suggested, these are sizes where volatility is uncomfortable but not catastrophic. Fourth, avoid common pitfalls. Don't expect immediate vindication. Monetary debasement is a 3 to 10 year process, not 3 months. Don't go all in on one asset. When it pulls back 40%, you can't handle it. Don't wait for certainty. By then, favorable positioning is gone. If you assess 30% odds of major debasement, position 10 to 20% of your portfolio accordingly. Fifth, consider legacy implications. You're not just protecting retirement, you're determining what you leave your children. In every major debasement, wealth transfers from those who stayed in debased currency to those who moved to hard assets. I've created a detailed PDF guide with exact percentages and tax strategies. Link in the description. Nothing here constitutes specific financial advice. Every person has different circumstances. Consult qualified professionals. But the signals exist. They have historical precedent, and they merit serious consideration. The choice is yours, but remember what's happening beneath Bitcoin's headlines. Central banks bought 1,000 tons of gold while reducing treasuries. Sovereign wealth funds are diversifying from dollar-heavy allocations. Major corporations put Bitcoin on balance sheets. The Bank for International Settlements publishes papers on central bank digital currencies, specifically to maintain control as alternatives like Bitcoin emerge. They wouldn't be concerned if the current system was solid. These institutions with the most sophisticated analysis are hedging against exactly what Bitcoin signals. They're not abandoning the dollar entirely, that's premature. But they're reducing exposure, preparing for a future where the dollar's purchasing power is meaningfully diminished. You have the same information they have. The difference, they're responding while most people ignore it. That's why this channel exists, to help you observe the same signals sophisticated players observe and translate them into practical implications for wealth protection. We live in an era of unprecedented monetary experimentation. 34 trillion in debt, 7 trillion in Fed assets, 2 trillion annual deficits. These aren't normal conditions. They require non-normal responses from anyone wanting to preserve purchasing power they spent decades building. In 1971, the smart money moved before everyone noticed. In 2008, the same thing. Right now, in 2025, it's happening again. But you're watching this video, which means you're early. The only question, will you act on it? Subscribe for Friday's video where we cover tax-efficient repositioning strategies and which specific inflation hedges have the best risk-reward at current prices. Don't miss it. The signal Bitcoin represents isn't about it becoming world currency. The signal is simpler. We're in late stages of a debt cycle with no resolution except monetary debasement, and people who understand mechanics are positioning accordingly. You don't have to believe Bitcoin reaches 500,000 to recognize that zero exposure to debasement-resistant assets while holding substantial wealth in bonds might be imprudent. You simply have to recognize that signals exist, have meaning, and responding thoughtfully is how wealth gets preserved across monetary transitions. The mathematics are clear. The patterns are consistent. The institutional behaviors are observable. What you do with this information determines whether you protect your purchasing power or wonder, 10 years from now, why decades of hard work resulted in retirement far less comfortable than planned. The signal is there. The question is whether you'll observe it carefully.